There we go. All right, recording is in progress. There we go. Beautiful in Michigan, Charles says. Maryland, 80. Whoa, no. Laurel, Maryland, 15 degrees above normal. My gosh, 83 degrees. Wow, Barry, that's amazing. Rain and sun and lots of growing happening down in Tennessee, Tripp says. Well, it's beautiful here in Seattle, and honestly, they say that the bluest skies you've ever seen are in Seattle. When it does sunshine here, it's really hard to beat. I've been all around the whole country. It's hard to beat. We just wait a long time for it to do that. Barry says 5 inches in 1 hour, once in a day, is not usual for Miami, but to keep going for 24 inches in 24 hours, unbelievable. Unbelievable. So Miami didn't get, it must have been just the center of the cell. It came right over Lauderdale, because I'm not seeing that it hit everybody. I mean, everybody got rain, but not like that. Unbelievable. All right, my friends, let us begin. Let's see, this will stop another screen sharing. Yeah, I do. All right, please tell me if you see the Trading Coaches Playbook logo. Should see it right now. Helen says, how are you feeling? You look rather thin. Yeah, it looked like I've got well, I mean, I've been telling you guys all along that I've been losing weight, and what happens when you lose weight rapidly is it takes a while for your skin to catch up, and it makes you look like you're a cancer patient or something. And so if it looks that way, Helen, I apologize, but I will tell you that I am healthier now, I think, than I have been in decades. And pardon me, and I love it. I love it. And I'm not going back. I'll tell you that. I've been this way since October. So how long is that? That's long enough to where I've established and kind of settled in. And I'm sitting right, between just a little over 180 to 185, which is exactly where I wanted to be. I will tell you guys something that happened really strange. I had the quick aside. My knee suddenly swelled up. It wasn't painful, but my right knee swelled up like crazy. My whole leg swelled up. I had a what they call a Baker's cyst rupture behind my knee, and it made my calf cramp, and my calf was just like it was ready to totally seize up for about a week, more than a week and a half. Saw an orthopedic guy. He sent me over. They did acoustic testing to make sure I didn't have any blood clots. No blood clots. Gave me a shot of cortisone, and as an anti-inflammatory, I had ballooned up. I didn't know what was going on. I had shot up to like 192 pounds, and that was crazy because I had been settling down in the low 180s, and so suddenly almost 9 pounds of jump, and I had this swelling. And anyway, the bottom line is, when the cortisone kicked in, guys, in 7 days I dropped 17 pounds. I kid you not. And that 17 pounds had to be all fluids that I was holding. So it certainly wasn't fat, but 17 pounds in 7 days. I dropped down to 175 on one morning, which is the weight I was in high school. And now I'm back up about 6, 7, 8 pounds, 7 pounds or so above that, that's where I want to be. But I have never experienced anything like that. 17 pounds in 7 days. It was weird. Every morning I'd get up, another 3 pounds, another 4 pounds, another 3 pounds. It was bam, 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 bam. And I was afraid. I called in and they said, no, it's just all the fluids being, your body's just dumping all the fluids that it's been holding. So that was a weird experience. And to find out that I have gout in my knee, of all places, no pain, and I can manage it. That'll be fine. I just was blown away. And that 17-point drop was just unbelievable. So anyway, I may look, Brenda, I don't know if I look anemic, I don't know, or Helen, I don't think I do, but if I do, my skin's growing back into it. So, all right, we have a fun class today. Let us begin, shall we? We always have the disclaimer up there. You've seen it long enough to memorize it. You've probably seen it enough times to memorize it. Here's our calendar coming up. Lots of incredible content. Thank you, Rob. Thank you, thank you, thank you. Does an amazing job. I'm glad to be just a bit player in this show, but Rob does a phenomenal job. Another event coming up. Make sure you take advantage of this. Counterintuitive trading. I love counterintuitive. All right. Phenomenal. All right, guys, I'm gonna help you with a skill set today. Whoa, Wayne says there's a delayed echo. I don't know, there shouldn't be. Anybody else having that problem? Wayne, usually that's a problem on your end with the audio settings, where you're getting two feeds that are coming in with a slight delay. I don't think anybody else has commented on that. So hope that gets worked out, bud. All right, market correlation. This is a fascinating subject, and there's ways that you can utilize this to your advantage, and I just wanted to teach you how to use it. This is a tool, it's a statistical tool that measures and determines how close assets move in relation to each other. Assets is kind of a generic term in the finance world that means assets, asset classes. There's all kinds of things that you can correlate or relate that to. It can be used for individual securities like stocks. You can see how two stocks correlate with each other, or you can measure general market correlation, such as how certain asset classes like commodities, securities, things like that, broad markets, how they move or how they relate to each other. Correlation is measured on a scale, -1 and +1. That's the whole scale, guys. You can't go higher than you can't go higher than +1. You can't go lower than -1. +1 is perfect positive, -1 is perfect negative correlation. So that just means how close they relate to each other. But perfect correlation is extremely rare. In one case, however, it exists 100% of the time. Totally irrelevant, but 100% of the time, and you'll see that shortly. Okay. Here's just an example of if you put 3 charts up on the board, this is the way a chartist, a trader, you and I would typically want to look at things. We like to look at things as pictures, different colors, different lines, different ways to look at lines. We like to draw lines on it. And from that, we infer things that are important to us, patterns and things like that. But the way correlation is used almost entirely in the financial worlds is different than that. It's not even looked at on charts oftentimes. So let me show you. Let's talk about this. So here's some good background. In 2011, various sectors in the S&P 500 exhibited a 95 degree of correlation. So 100 would be a +1. 95 degree of correlation. That beat the former record that was set back in 1987. The high correlation meant that everything was moving basically in lockstep with everything else. If the market went up, everybody went up. If it went up 1%, everybody went up 1%. 95% correlation like that. Well, when that happens, it's very difficult to pick stocks that outperform the broader market because everybody's doing exactly the same thing. It is also very hard to select stocks that, well, in different sectors might increase the diversification in a portfolio. So you might say, well, I want to have some of this, I want to have some of that, some of that, some of this. This one goes the opposite of that one. So if the market goes down, this one will go up. That's how you use balance in portfolio diversification. Well, it was real hard to do because there was nothing that was diverging. Everything was moving the same. Investors had to look at other types of assets to help manage their portfolio risks. In other words, people were looking at all kinds of stuff. Let's see, is real estate doing it? Yep. Is gold doing it? Precious metals? Yep. Tech's doing it? Yep. Everybody was doing it. And it was hard to find anything that would give a diversification play in a portfolio. On the other hand, the high market correlation meant that investors only needed to use one simple index fund to gain exposure to the market. So if the market was moving up, simple thing to do was just You could throw a dart and anything you hit was moving that direction, or you could just do an index fund. And for quite a while, a lot of people just said, hey, I'm just doing the index funds because overall they're doing as good as everybody else. Instead of trying to pick individual stocks, I'll just use an index play. And that's where those kind of things come in to use and in vogue, is just based on basically on how the markets are using now or behaving. Another interesting aspect of correlation is with respect to volatility. When markets get volatile or they get very unvolatile, very dormant, you see an effect on a lot of the market. And what you look for is that if there's a high increase in volatility, if it's a systemic action, in other words, if it's something that is scaring everybody, then everybody heads for the door. It's like shouting fire in a crowded theater and setting off fireworks and saying there's a guy with a gun or something, and everybody heads for the door. Okay, so high volatility, high correlation sometimes. But as we said before, that tends to mute any differences. However, it does allow you to look for significant divergences. Here's where traders come in to a whole different use or a whole different value to correlation than investors. Traders, investors, very different most of the time in their motivations and their behaviors. There are websites that list correlation numbers, okay? They give you all kinds of great data. But for traders, those charts, which you'll see in a minute, are not nearly as valuable as a trading chart, okay? A chart that lists numbers is not nearly as valuable as one that shows pictures that you could actually use, all right? So visualizing correlation, that's where traders come in, because investors visualize it in a very pragmatic, linear fashion, looking at matrices with lots of numbers and correlation of this line with that line and this sector with these numbers. The whole thing, my eyes start to go buggy, and I don't enjoy that at all. Show me a chart, show me a stock chart, or any kind of a chart where you plot data on it, and I'll make sense of it, okay? But when I get to these big Excel program matrices, I get a little blurry-eyed. Now, some of you don't, but I do. Look, when you do overlays on charts, when you want to visualize it, the easiest thing to do is compare one stock with another. And we're going to do a bunch of this today. Okay, we're going to do some of this in a little bit. You can compare sectors. You can compare a stock in a sector. You can compare a sector by itself and look at all of the stocks in the sector and overlay those stocks. You can do whole market comparisons, different ways to look at the market, or different markets altogether. There's all kinds of stuff you can do. And you can either do it in a matrix or you can do it in a line chart. And I prefer the line chart. But volatile markets need to be evaluated for correlation. When we do have volatility, you want to look at it. And here's why. You may be looking back on historical comparisons, which I love, the ability to look back. You can't do that on a matrix, but you can sure do it on a stock chart. You can say, let's look back at the last recession. How did this stock correlate with the market movement? What about the one before that? What about the one before that? What about the last significant run-up? How did it behave in that? You're looking oftentimes for leading or lagging correlations. So look at this. What if every time the stocks take off, you feel like you missed it? Anybody feel like that? When something takes off, who feels like it's scary to jump in if you didn't jump on it right up the beginning and you feel like you missed out? You're hesitant to jump in because it looks like, oh, shoot, everybody's already going. You know, I should have gone in 2 days ago. Should have jumped in 2 days ago. But now, boy, by the time I get in, it'll probably turn and go the other way. Anybody have that kind of feeling besides me? Brenda says sometimes yes. Okay. Well, Brenda, it's you and me and Trip. Okay, there's 3 of us that can relate. Nobody else can relate. So, oh well, I'm going to make the point anyway. Looking at leading or lagging, you may be able to find a stock or a player in whatever sector you're looking at, whether it's an index, a sector, or an individual stock, You may be able to find something or somebody that is always late to the party. What if there is somebody that's always the one that jumps out, the one you always miss? Well, quit trying to chase that one. It's like, the kid says to his mom, "Mom, it hurts when I do this." Well, quit doing that. Every time I try to trade this stock, once I get started, it's already done. And I get in very late, or I wind up getting in when it turns and goes the other direction. Well, don't do that. Well, how am I supposed to play it? Well, okay, how about this? How about if you find out if there's another player in that sector that lags? It always follows. Eventually it responds, but it doesn't do it right quick. It's not the first player. It's the second or third or fourth player. And so you now look back historically on the charts and you find out that, hey, it does this a lot. Wow, it does this almost every time. Bingo, now you found something. Now you found something. You found correlation, and you're using it as a trader the way a trader should find correlation. What if you find that leading oddball, the one that always jumps out? Okay, does that mean that you can play that? Well, maybe not, but you can use that now as a benchmark to start looking for the other plays. And there can be several versions of that, not just the lagging, but there can be several versions of that. Okay, so let's start. Here's one of those matrices. Now, if you look going across the top row, you see the euro and the US dollar. Going down the bottom row, you see euro and US dollar. The reason that it's pink in the middle there is because it's always going to have a 100% correlation. Why? Because it's the same thing. If you compare U to U, you get 100% correlation, right? You compare U to U. What do you go down to the second one? Okay, GBP. Cross the matrix, they're also pink, 100% correlation. And you see it always goes down in a diagonal line because you put the same list across the top, same list going down vertically. And now you can go in and you could over here, let's say go over 1, 2, 3, 4, 5 to the US dollar, Canadian dollar. And you say, I want to compare that to the euro and the US dollar. So you drop down and whoops, come back here. There we go. You drop down to that second line or the first line, and you see it's a minus 791. Okay. So it's not a minus 1, but it's a 0.79 and basically a 0.8, which means it has an almost perfect or a very high negative correlation, which means they don't follow each other at all. There's an 80% chance that the US dollar Canadian dollar pair does not match up with the euro US dollar pair. Okay. Now go over to the next row or the next column, and you have the Aussie US and you have the euro, and now you have a 90%, 8.89 correlation to the positive, which means those guys are linked at the hip. They're almost a perfect correlation. Look down over this and try to find a 9. Do you find a 9.9? I see 1. I see 2. Okay. The US dollar, the GBP US dollar, 0.96, almost a perfect correlation. Well, you would think, which is British and euro, they're going to be pretty darn close. Drop 1 down below and you got an 80% non-correlation with the US. See, now this is all interesting if somebody explains it, but what do you do with that? How do you trade it? Well, I mean, Brandon probably uses something like this, and people that use trading currency pairs, maybe they do stuff like this, and maybe that helps them. I don't know. I don't know how to do that. This is interesting. This is actually stocks. So here we have the same thing, and they actually put the 1 in there. So you see the first one, American Airlines, AAL, and the first row or the first column and the first row, AAL, 100% correlation. And again, it goes down because you're listing everything. Now here, when we look at the, let's see, we'll go here and we'll look at Amazon. And we'll look at Amazon and American Airlines, right? That's the first row. So it's a 0.87. That's pretty high. Okay, that's a 0.85. That's pretty high. But let's look on here and let's see with Amazon, anybody's higher than 0.85. We go down and go, boom, there's a 0.92, Akamai Technologies. All right, well, that's kind of interesting because they're closely related. But then, boom, we go down and we get an Amgen, which is weird because Amgen is not an Amazon competitor, but you have a 94% correlation. 100% is Amazon to Amazon, of course. And then you go down, you got a 94 again with Bed Bath & Beyond. So here we have high correlation with one or two companies that are in related sectors, and you have a very high correlation with a couple of companies that have nothing to do with Amazon. Okay. So what do you get out of that? I don't know. I mean, you can look at this and it's interesting, it's fascinating, but you know, I don't know how you use this when you're looking for stock trading. It's interesting. Tripp says, yeah, Brandon shows commodity correlation a lot in many think tank. Well, and as he should, because that is a very distinct characteristic in trading those, you know, trading those the E-minis and other where you're looking at trading pairs. Brenda says, how do you read this thing? Well, Brenda, don't worry about it because you don't need to. I'm just showing how a lot of the investment world uses this. But Brenda, follow me here. Can you see where my cursor is? I'm over on Amazon. Go across the top row to Amazon, right? Brenda, go all the way down till you hit a 1.00. What line is that? You go over to the left, it's Amazon. So Amazon trade compared to Amazon is 100% correlation. Anything that is, and that's the only one that's going to be 100%, by the way. But you're looking for anything that's close. So in that column that's underneath Amazon, you're looking for anything that's close to Amazon, and the closer the better. If you were trying to find a play that, let's say, I can't trade Amazon because it's too expensive. All right, well, then let's see if we can find something that moves really closely with Amazon that's cheaper or might have cheaper options. That's one way you might use something like this. Okay, this could give you, by the way, Brenda and everybody, this could actually give you one scanning tool that you could use from a trading standpoint. If you had a chart like this, something that rated them, you could say, I want to find companies that are highly, highly correlated to Amazon because I want to see if there's something that is a cheaper option to play, something that's tech related. Well, you could go to Akamai. Okay, Akamai Technologies 0.92 correlation. That means they're going to move. So if you can follow Amazon, it's just too expensive. Well, then maybe you could play Akamai because the options might be cheaper, and it'd be like playing a surrogate to Amazon. Does that make sense? Jennifer says, so this is like a beta of one with the S&P 500. Yes, if 1.2, then the stock trades 20% more risky than the S&P. Yes, but you'll never have anything higher than 1 here, Jennifer, because you're comparing this with a perfect comparison, which is itself. Nothing can out compare itself to yourself. Okay, that's why 1 is perfect, and it's extremely rare. It only happens when you're comparing it to yourself, essentially. And a -1 would be they never, whichever one moves up, the other one moves down every time. It's just the exact opposite. That'd be a perfect negative correlation. Brenda, I'm sorry about that. But the bottom line, Brenda, is that if you were looking down the Amazon column, the closer you get to 1, so a 0.8, 0.9, 0.92, 0.94, that means the closer you are to following Amazon. If you laid those two, and Brenda, this will make perfect sense when I show you a chart and do it the way you should do it. Okay, so don't be discouraged. This is the way geeks do it. Okay, this is the way number crunchers do it. Nothing wrong with geeks and number crunchers, but this is the way people who parse through investment data and risk analysis, they go nuts on this stuff. But this is not for traders. I already told you that. This is not for traders. Tripp says, hey, careful, I resemble that remark. I knew I was going to get somebody here. All right, now this is looking at different markets. These are flags, okay? So you look at the flag, you say, oh, there's our flag, you know, there's the US flag. And if you recognize your flag, there's Mexico's flag. They go across the top and they also go down vertically. So you see the black boxes going down at a perfect diagonal. All right, that's because at a black box, you're going to have the same flag on the same row. Row down here where my cursor is, We move all the way over and we get a black box. We go straight up. Oh, that's the US. That's why it's black. That's because it's saying all of the black boxes mean perfect correlation. So now the US markets, just look down here. It's just for curiosity, grins and giggles. Who has the highest positive correlation with the US markets? Well, you'd have to recognize the flags. And I don't know those flags. They're too tiny. But the second row is a 0.87. And as I look down here, 0.86, another flag that I don't know. And that's it as far as that goes. So with the US market, there's two countries that have an 86 and 87% correlation with our markets. Okay. I don't know the rest of the flags, although I saw Mexico. Let's see, Mexico, where are you? Right over here, 1, 2, 3 rows or columns over. I think that's, no, 4. There's Mexico right there. So we look down, does anybody correlate with Mexico? So far, nobody correlates with Mexico. Wow, look at that, 0.4, 0.5, 0.1, -2. Basically, nobody correlates with Mexico. Anyway, interesting. All right, here's your key points. Again, correlation is measured on a scale +1 to -1. Correlation can be used to gain perspective in the overall nature of the larger market, or to measure the amount of diversification there is between asset classes. A bunch of word salad, I know. But you're just looking for relativity. How close does this stock market, individual stock, commodity, currency, how does it line up with anybody else? Is there anybody else that is really close? Or is anybody that's really, really opposite, so I can make an opposite play? Choosing assets with low correlation with each other can help to reduce risk. Why? Well, because you'll have one that moves up, the other one moves down. So if you had a -7 or a -8 correlation, an investor would want both of those in their portfolio. Now, they would say, I want it because if one goes up, the other one goes down, I protect. Yeah, true. But if one goes up, the other one goes down, so you don't make any money. Yeah, but I'm protected. Was that your goal? I want to be in the market and not make any money, not lose any money. I just want to be in the market. So I want enough protection to where I don't lose any money, but as a result, I don't make any money. It kind of approaches that, and it gets a little bit esoteric, a little bit weird. Got to take a little bit of risk if you're going to make any money, guys. That's the way it works. So pay attention to the bottom 3 lines. While correlation is a statistical measure that's commonly used in portfolio risk management, it can be helpful to active traders. If you can stand to look at something like this, you might be able to find a few places to look without having to just start from scratch. If you wanted to correlate to Amazon, you could look on a chart like this and find the top 3 or 4, and that would be a way to start. If you wanted to correlate with or look at Adobe, well, who correlates with Adobe? I go down here, nobody, 0.68, no. Okay, how about Apple? 0.9, 0.9, that's Autodesk, that's Altera, 0.88, Bed Bath & Beyond, again, another outlier. So you might be able to make some sense out of that. If you don't worry about it. Don't worry about it. So here's the key points. Here we go. Finding a lagger with a high correlation or a cheaper play can be a big winner to traders, and correlation can help you do that if you use charts. But you're not going to find them on a correlation chart like this unless you learn how to at least thin the herd a little bit and find a few potentials, but you're not going to find them without looking at a chart. You're not. You're going to find it by looking on a chart, a line chart. All right, again, as a numerical tool, it's an investor tool. It helps place assets in diversified markets and sectors, yada, yada. Traders use correlation differently. They use it visually. They want to see correlation as a tool for divergence. Why? Because it's a pattern, and we like patterns. Anything that's a tradable pattern is something we're going to be able to use. Both high and low correlation can be trading signals, guys. Now, again, I'm not looking at the matrix. I'm saying when we see it on a chart, those can be trading signals. Patterns are golden to traders, so anything that has historical correlation, positive or negative, is more predictable. If you can find historical correlation, either positive or negative, it adds to the predictability of the play. Okay, and those are probabilities. as Tripp will tell you, your odds and your probabilities can be slightly different. Basically, odds on any trade you ever make is 50-50. It really is. Probabilities can be higher. You can say, well, it's done it 7 out of 8 times. Okay, then you've got a high probability. But what are the odds that this next one is going to be that? And the answer is, unless there's some other pattern, you've got more data, the odds are 50-50. The odds are 50-50. What if it trades 6 out of 7 times the same way when you get a certain signal? Okay, you've got one outlier. And you look back and you say, now this would never happen. It goes 6 in a row, and then it fails on the 7th. It goes 6 times in a row, it follows the signal, then on the 7th. And if it's done that for 10 years, yes, you have a high probability, as long as this is not number 7, that it will follow that signal. I get it. Is it 100%? No, and you've got to look at it as a 50-50 proposition. It just is. You have to always be neutral when you go into a trade. But we're looking for correlation. We're looking for patterns. We're looking for probabilities. And so when you look back and you say, this is highly correlated to either a signal or another stock or a sector or a market news item, whatever it is, you're looking for that correlation. If it's a high correlation, then it gives you a higher probability that the trade will work. Okay, and that's all we're trying to do, is put the odds a little better. Yes, 50-50 is the odds, but we want to have higher probabilities. Okay, so here's a chart. So let's get into the world that you and I are probably a little more familiar with. So here we have a chart of the S&P 500. Underneath it, we have bonds, we have gold, we have the yen, we have the dollar. Okay, different asset classes. Okay, currencies, precious metals, bonds, which are derivatives. The yen and the dollar are both currencies. And now what you're doing here is you're looking for correlation. Well, if you had a vertical line that you could slide along, you could say, well, okay, I see when the market, the S&P does this, bonds do that. When the gold does this, the yen does that. And you would be looking for something that would give you any kind of a pattern that you could see that would be a reason to set up a trade with a higher probability. Okay, this is the world that I get excited in. Here you go, the Australian and the Japanese yen versus the S&P 500. So the blue line is the pair, the currency pair, and the black line is the S&P 500. So now we're looking at the first third of the chart. They're correlated quite high. Okay, you have a market that's going down, very consistent with the currency. It's a little more choppy with the S&P 500, but it's still accomplishing a downward move. So high correlation, yeah, pretty high, but not that high. Here for the next month or two, it's very high. And then suddenly it starts to break apart and the correlation becomes very low. So this is where the low correlation would exist, Brenda. You'd get minus numbers here because one is doing one thing and the other is doing the opposite thing. So you get minus numbers, right? And then suddenly it starts to lock in again. So what's the value here? To me, nothing. I don't see anything I would want to trade. Why? Because the correlation is there. Sometimes it's there not sometimes. And sometimes it's sort of good and sometimes it's really good. And then sometimes it's horrible as far as, so the only pattern there is a bad pattern. I wouldn't use that. I would say, wow, that's something that doesn't help me at all. Okay, not at all. So I go to the next one. You guys, you can compare anything. And I have a friend that told me once, he said, nothing is good or bad except by comparison. That's an interesting statement when you think about it. Sometimes that can give you a reason to just kind of just to chill out, you know, just to not get so anal about things. Nothing is good or bad except by comparison. You could say, I like that. There's a there's a joke about, well, I won't go there, but the bottom line is, you know, you may say, well, I've got it really bad until you meet somebody who's got a whole lot worse and you're going, oh, well, I guess I don't have it that bad. But the only reason that changed was because you had a comparison. So here you can, guys, you can compare anything. This is high expensive homes, you know, $1 million plus homes driven by equity markets. So what do we have here? S&P 500 and we have $1 million house sales. So we see the light blue line, S&P 500 is going up and you have an inflated run in expensive homes. Okay, well, you might explain that in 2005 and 6 and 7. And then we have the big Great Recession that happens in 2008, and there's the fallout. And then they start to climb again. Only this time they're more tightly correlated because why? Well, because that was quite a shock there, and people did not get quite so hyperinflation on expensive houses because they're still remembering how much that hurt. Ouch. You can see the percentage drop in expensive houses was much bigger than the drop in the market. Okay, so that leaves a mark. And so now for years, you have a much more tightly correlated market. So for some reason, if you were playing Pulte Homes or Toll Brothers or Lennar Homes, something in the home building sector, custom home building sector, well, then you might want to pay attention to how well it follows the market. And if it follows the market very closely, well, then you would want to keep that in your decision-making process. Okay. Here's another one. This is interesting too. This looks at inflation as it connects up with market yields. So when you look at the S&P 500 real earnings plus dividends, these are adjusted for inflation. And there's the S&P 500 as a market up there. So you're comparing earnings in the market to the market itself. This goes clear back to 1970 and all the way up to 2019. That doesn't go all the way. But what you're looking at is look at the drops in the real market, the S&P 500 real earnings plus dividend. You can see the Volcker bear market in 1980, the 87 crash, the dot-com bubble, the Great Recession in 2008. And you can see where it is. And then you see in 2009, we're at the lowest S&P real earnings plus dividends. And guys, guess where it is right now? 2 years later, 2.5 years later, guess where it is right now? Anybody know? Anybody guess where we're at relative to, we were just about, we were 0.4, just above 0. Where do you think we're at 3 years later? I'm guessing. I'm waiting for a guess. It's not a pop quiz. I'm not grading anybody. I'm just asking you where you think. You've been living the last 3 years in the market. Where do you think we're at? Trip says lower. Anybody else want to venture? What does it feel like to you? Real earnings, real profitability, adjusted for inflation. Charles Grimace says record low. Absolutely. Absolutely. We've been as low as -4. It's huge. You're right, Chip. I mean, it's -4. All-time lows. Okay. Things are not happening in the market the way they were. And it's scary right now, quite frankly. It's scary. All right, here's another one. S&P 500 earnings yield, and this is compared with the S&P 500 PE ratio and the Consumer Price Index, the CPI. Okay, I'm not going to dive into this. I'm not going to make any points here. I'm just showing you that when you put charts together, you can see if they're correlated or not very easily. Okay, over here, let's not go back to that. If we look in the last decade or two, we see that there is not a high correlation between the CPI and the PE ratios. Barry, did you say -4 or -0.4? Barry, it's gone to -4. Okay. Yeah, it went negative. It went negative pretty good. All right, for traders, let's take a look at this. Let's sum things up here. Correlation or lack of correlation can find targets because it can find patterns. You can find laggers, stocks that lag behind leaders. Okay, lag behind leaders. How's that helpful? Well, as long as they follow and they do it, then you don't have to catch the first one. You can jump on the second horse or the third horse and ride in the same direction. That's awesome. You can find knockoffs. Well, Amazon's too expensive, but here's 2 or 3 other stocks that follow it that trade much cheaper, but they have similar type of movement. Here we have delayed reaction relatives. Okay. So you might have something that is in a similar sector that this is kind of like laggers, but you get delayed reactions. Sometimes this will be significant. All it is patterns. You're looking for patterns. So when I say, let's go fishing, I say, let's go fishing, because what I want to do is to go to charts, and I want to play a little audience participation and want to have you guys throw some comparisons out here, some suggestions, and we'll do a little bit of fishing together. So with what we've learned today, I want you, and especially Brenda, putting you on the spot here, my dear, I want you to give me ideas of what we might compare. Okay. Here we have the S&P 500. Here's the overall market. Now, we can start here, or you could say, I want to look at Google and Bed Bath & Beyond. Why would you do that? I have no idea, but we can do that. And we look for correlation. You could also say, I want to look at Amazon, for example, just a name, Amazon, and pick a indicator. Okay. I want to look at Amazon and RSI, or Amazon and you pick an indicator. Okay. Jennifer says, how about looking at Meta and NVIDIA? Okay. So let's put Meta up here. Okay. And let's bring this in a little bit closer right here. And we'll do a comparison. So I'm going to type a C here, and it says, how do you want to do this? Well, I want to overlay it as a line chart, or you could do it as bars, but we'll do it as a line chart. And we'll say, okay, so what do you want to compare it to? And she said, NVIDIA. All right, now let's compare them as line charts together. Now, what I'm going to do, let's see, that was Jennifer, right? I've got to look back up. Yeah. Okay, so Jennifer, what I'm going to do is I'm going to make one of these come on. Getting a slow response here. Nav not responding. How come? Try this again. So what you can do on this is you can just click on the line normally. Come on, wake up, son. Quit doing that. All right, never mind. I was just going to make the line thicker, line heavier, so it's a little easier for you to see. Well, I'm getting a real slow response here. There we go. There we go. There we go. All right. Line width. Let's make it medium thick. There we go. All right. So now there's your NVIDIA play. Meta is the thinner line. So Jennifer, now what we're looking at here is what? You can follow I've got the vertical line on here for a reason, so that we can look at peaks. Peaks are the same, bottoms are the same, bottoms are the same, peaks are the same, triple tops are the same. This would be highly, highly correlated here, except Jennifer, I can see something happening right here that would be interesting. I would take note of this behavior right here. Okay. And I am going to change, if I'm going to draw lines here, I don't want it looking like these other lines that are on there. So I'll make that kind of this bluish color, all right? What do we have happening here, Jennifer? What do you see? What do you see with NVIDIA that you don't see happening with Meta? There you go. So here you have NVIDIA trending up with Meta holding level right here. Now, NVIDIA is not an indicator per se. It's not a technical indicator that says, hey, something's changing, something's going to happen. However, the correlation can become an indicator, okay, if it's consistent. So what happened here? Well, NVIDIA moved up and then both of them went down. You know, for some reason, they're perfectly correlated again. Perfect. Okay, and then what happened? NVIDIA did it again. Okay, we get another run to the upside. And why didn't I make that permanent? So what you do is we're going to change this line again. And let's see, I want to save as the default. There we go. Okay, so now we have NVIDIA moving up, but it did it before Meta. Okay, so here we had a what we would call a bullish divergence. What happened? Nothing. Here we have a bullish divergence and we have a big drop in Meta, and then it turns around and recovers. So one was a divergence, nothing happened. This was a divergence, sort of something happened. So I wouldn't say that is a strong correlation. And then now, for the last year, this year, we've been back in a perfect correlation. So essentially, you could say Meta and NVIDIA, with only a couple of exceptions, track each other. Now the question would be, does one lead the other one? If you were using this in some kind of a way to decide to trade one or the other, well, you say, well, does one lead the other one? Does the other one follow? And the answer is, I'm not getting any real clear signal on that. I'm not seeing where I could use this. It's interesting, but I'm not seeing anything I could use this to trade with. What am I missing? Is anybody seeing anything? Jennifer says, I don't see a leading either. I don't. Anybody see something I don't? Let me know, because I just don't see it. Okay, let's try a different one. Next comparison was, I've got to scroll way back up here. Trip says Intel and AMD. Okay. So we'll bring up Intel. Then we'll put AMD on here. Okay. So Intel is the dark line. AMD is the kind of purplish line. And if I put Intel into candles, it makes it a little easier to distinguish. And I don't think it's too tough to see the correlation. Although with me, I want to look at line charts. So I'm looking back here, we go back to 2022 and we see bottoms and tops, although AMD has a much wider swings on the downside than Intel. So whatever was pushing that sector of the market, the chip sector, down, it affected AMD a lot more than it did Intel. So let's go the other way. We get a market move to the upside, AMD outruns it. Down to the downside, it outperforms the outruns the upside. So there's a correlation here I'm starting to see, outperforms the upside, way outperforming the upside. So both of these in the chip sector, very, very strong competitors with each other, very strong competitors. Trip, what are you seeing? I was just going to editorialize, but I'm going to wait to see what you see. What do you see when you see this correlation here? Barry, if your comment, I think, is on, it was on, I didn't see when it came in, but if your comment was on Intel and AMD, he said they correlate monthly, but not on a weekly or shorter time frame. That might have been the previous comparison we were looking at. I didn't see that. Trip says, agree. The bigger moves by AMD, better for trading for me. Yeah, so, and see, this is kind of cool because Intel arguably is the bigger dog, no question. So you could use them as kind of a barometer. And when you see a move, you would see, if I want to play chips, the chip sector, I want to play something like AMD because the moves will be bigger, either up or down. The moves will be bigger. And that's a direct correlation. So here is a good tool to see correlation. Now, if you were on a matrix, it would show an average over the last several years, and that number wouldn't be helpful. What the history does is you can see that it is exaggerated. So the correlation would go higher and then negative, and then higher and then negative. And what would you do with that? Well, you might not do anything with that if you were an investor, but here as a trader, when you look at the chart, you can say, I don't even know, I don't need to know what the numbers are. What's the correlation? Is it a plus or is it a -4 or a -9? And the answer is, I don't care. At this point, I'm looking at correlation. I don't need numbers. I see numbers. I see the whole picture here. All right. Is that helpful? Now let's look at the next request was gold and the S&P 500. So let's take AMD off of here. There we go. I'll use that, and we'll put we'll use a surrogate here, if that's okay. And let's see, Brenda. No, who was it? I got to scroll way up here. There we go. Elsa. Elsa, you're up. Okay, I'm talking to you. All right, so Elsa, we're looking here at gold and the S&P 500. How close do we correlate? Now, you would think by listening to people on the radio that every time the market gets weak, you need to buy gold, you need to buy gold, because it goes opposite. You know, gold's been moving up. Yeah, okay, I get it. But what are you seeing here with gold and the S&P? Anybody seeing anything interesting? I'll put one of them in a candle chart so you can kind of see. What are you seeing on correlation? Brenda says it almost seems like gold is leading the way. Well, I'm not sure about that. Let's take a look. It definitely had the correlation that they always talk about on the radio when they're trying to sell you gold right here, which is in March. In March, the market dropped and gold went up. And they would say, see, I told you. But wait a minute, now the market's climbing along with gold. Well, yeah, but it diverged there. Okay, well, what about the month or 2 or 3 before that, where it was doing exactly what the market was doing? In fact, when the market came up, gold suddenly took a dip. How come? The market was moving up. Well, they move opposite. No, they didn't. Not for the month and a half before that. Now they're moving together. Now it separates for a few days and then really only a few days, and then it's correlated again. Well, there you go. There you go. So it's kind of interesting. And this is the kind of thing where good charting skills, guys, come into play. Please, so I don't have to scroll. Oh, wait. I can do this. I just have to stretch the text chat way the heck up here so I can look way back. And the next one is SPY and the Qs. All right, Brenda, you're up. So SPY, we'll do the comparison for the QQQ. Okay. All right, Brenda, now we're looking at Qs and the SPY. So what do you see? Look back through 22, I see perfect correlation. This would be almost a 1-to-1. That's not surprising. Now we have a little separation here. The Qs fall farther. then they outperform on the upside, then they go back kind of in sync with some separation, and now they're back in sync. So for about 6 months here, 5 months, they were still moving the same way. It's just the Qs started to underperform the market a little bit, but the proportion was still there. I mean, they lost a little bit of a step, and now they've got it back. So to me, what I'm seeing is a perfect correlation. Okay. Okay, so Chip said, what about Bitcoin and the S&P? Well, okay, that'll be our last one. We'll take a look at this here. Give me a ticker for Bitcoin. I don't type this in or follow it enough to just coin. That's right. Thank you. Okay, Chip, what are we looking at here? First of all, S&P is this one, is the candles. Bitcoin is the line. And this would be a good way to look at it, actually. So what do we have? Well, we were in correlation. It overshot the downside. It went up, it went down, it went up, it went down, it went up, it went down. Pretty tightly correlated in movement, just not in proportion. Okay. And there it falls again, farther than the market. And now we have a divergence where the market went up for about, through December, about 2 months, and Bitcoin went down. They bottom out, they run together, pull back, run up, and now it's kind of separated again. More correlation here than I would have thought. A little more than I would have thought. Interesting. Yeah, Trip, you're right. I just went with that, but you're right. I thought Bitcoin started with a B. That Coinbase, that's another one here. Let's throw that on there. This will be interesting correlation. So let's throw a different one on here. So okay. So now let me see if I can, before we run out of time, let me change. This will let me do it. Come on. This is maddening. Maddening. Let me bring it in closer so I can get right on it. Come on, how many different, there's several different ways I can ask it. There, it finally responds, my gosh. All right, let's pick a different color. We'll make this one green, and we'll make it a little bigger. Make it medium. All right, here's our last comparison, guys. Okay, the green is Coinbase, the purple line is Bitcoin, and then, of course, the market is the candlesticks. So now we can go back and we can see Bitcoin and Coinbase. How closely do they correlate? How do they correlate with the market? Bitcoin and Coinbase basically are going lockstep, except for this last couple of months. Interesting. And it's simply that Bitcoin fell, or Coinbase fell farther back. Bitcoin has stayed up, had a bit of retracement. Now it's kind of linking up again. But guys, this is, again, what you would look for to utilize correlation. If you're looking to trade an expensive stock and you want to trade a cheaper one, find everything in its sector and start comparing them and see if you can find one that follows the pattern, but maybe it's less expensive. Great. What if it follows the pattern, but it lags it by a few days? What if it leads it by a few days? You might find an absolute diamond. You literally might find a diamond. I almost can guarantee you that somebody else has found it out there, but they're not saying a thing. They're not saying a thing. They're saying, hey, you know what? I'm keeping this one to myself. I'm not telling anybody about this. I don't want to get out and have a bunch of people do it, and then it'll show up and get manipulated, and it won't work anymore. That's what often happens with patterns, by the way. That's just kind of the nature of patterns. But if you can find something that you can find a correlation, either a positive or a negative correlation, where it leads or it follows, or it just follows it and it's a much cheaper play, you have found something. And now you can utilize this in a positive way. Okay. Elsa said that the disruption in their correlation was probably due to the FTX turmoil. Maybe. I would think that that makes sense. Okay. Yeah, Trip, I just see your comment. Yeah, you can do it several different ways, but it normally is more responsive. And I was trying to do it on the on-screen way. And yeah, eventually you go up and you right click on the, what I was doing there, guys, if you go up and you right click on the added symbol, the comparison, you can hit edit and it'll bring that box up. It's just that you're supposed to just click on the line and it usually does the same thing. But even though I clicked edit, look how slow look how long it took. So I'm just getting some latency problems here, and let's just have to deal with that. All right. Hey guys, hope you had a good time today. Hopefully it was valuable. I think it is. I think it's very valuable if you learn how to utilize that. And when people talk about correlation, you go, oh yeah, I know all about that, but I don't do it the traditional investing way because I am a trader. I like to see pictures. Okay. I can make sense out of pictures. I don't necessarily want to look at a big matrix of numbers. You know, other people get, hey, have fun. That's candy to them. But show me a picture. That's candy to me. All right, take care, guys. God bless. Have yourself a wonderful day. And Brenda, oh my gosh, thank you. Guys, if you see what Brenda said, she said, listen with your eyes. That's a phrase that I coined. As far as I know, I've never heard it associated with anybody else. But I said, you know, the stocks will talk to you, guys. The market, the stocks will talk to you. They'll teach you how to trade them, but you have to learn to listen with your eyes. Okay. So that's what Brenda meant when she said that. That's one of my phrases. Listen with your eyes. It'll talk to you, but you have to use your eyes. How about that? All right. Take care, guys. God bless. Have a wonderful